Hi there. My name is Bill Warner, and I'm with EntreDot, as you probably know. Um, this is Facebook Live. Welcome. This is Monday night live with EntreDot. Clever, huh? Well, look, as I announced previously, we're going to talk about exit strategies. Now, I realize that this subject pertains to mostly businesses that are tech or life science, or any other company that's taken on equity investment. That means people or organizations that have invested in your company and have bought shares in it. They are part owners of your company, and they did that because they would like a return on that investment, whatever it was, knowing that they took great risk in investing in your company in the first place, probably very early on, as angel investors often do. And they're going to want a substantial return, multiple times their money back, in some period of time. And I am purposely vague on this because the amount of money they want back is greatly dependent upon how long they think they're going to want to wait to get it back. So if they got to wait a long time, they want a big multiple on their return. If you can give them a return on their investment in a couple of years, the multiple will probably be substantially less. But more about that later as we get into the dynamics of this. So I wanted to help people, particularly tech and life science entrepreneurs, and those that invest in them, perhaps, who know this subject quite well, what an exit strategy is all about and how it's got to be managed. So you start with, very early on, a business that does have a business model, and you've done a financial forecast, and you have a view of what your company's, let's say, earnings will be in some number of years down the road. And you could do the arithmetic to determine, based on industry multiples and your earnings multiples is what I'm referring to, what your company could possibly be worth based on the business model and the projections you've made. So you have some idea when an exit could possibly occur and how much your company could possibly be worth at various points in time. Before you talk to investors, it is important for you as an entrepreneur to kind of understand, not kind of, absolutely understand what the future financial dynamics of your business could be. Now you're going to say, well, this is all financial mumbo jumbo. It's guesswork. It's unreliable. I don't know if it's really going to happen that way, but I'll tell you something. Nor does the investor. And you're going to be the one they rely on to give them some clue of what they could expect. So this is a discussion. It's a set of judgments based on a set of assumptions, all of which could be partially true, totally true, or not true at all. Somewhere between those two extremes. So if you have a view of it, you're going to enter a discussion with investors with some viewpoint on what an exit could look like. So once you got that in place, and you've got an understanding of the timing and the amount of money that is going to be necessary to provide a good return for yourselves as well. But the next step is to start looking at investors. You don't call them up yet. You go to their websites and anything else that's public domain information that talks about them. You want to understand their strategy. So more often than not, angel investor groups, venture capital groups, some private small groups, not private individuals, however, put on their website their investment strategy, the size of their fund, what an expected return could be or they want to have, what they kind of expect for the amount of time they're willing to wait for a return on their investment. They have a portfolio that they're proud of, and you'll see the names of companies, and you go to their websites and you can see what their business model is and kind of get a feel for their business model is kind of similar to mine. If so, there's a good chance that this investor group is going to be attracted to your business model. So you're doing this to try to make sure that you have a reasonable level of alignment between the two of you and your expectations for exit. If you are way out of line on expectation for exits, your chances of getting this investor interested in your business model is probably pretty small. And perhaps to the point where you shouldn't even bother approaching them. So once you understand their strategy for exits, coupled with your judgment as to what your exit could look like, you got a match, and you put them on your list of investor organizations that you want to approach. Now, once you got that alignment in your plan and the presentation you make to these investors, you are going to have to talk about your exit strategy. Now, I have to be honest with you. I along with my partner, Rich Kamarick, run an angel investor fund here in RTP, along with several other well-established organizations. And we've all done this for a long period of time. And there's a lot of talk emerging about our expectation for exits and how well we're managing for the results we want to achieve. So the longer it takes, I think angel groups get a little bit more antsy, and rightfully so. So maybe something that we've got to think about as investors is that we've got to pay more attention to this, as I'm urging the entrepreneurs here to do the same. And have these discussions about exit very early on. So when you develop your exit strategy, it's not I call it a fluff ball chart with a bunch of logos on it. Say, these companies are likely targets for us to gain an exit. Isn't this wonderful? And that's the amount of research they've done. They've named a few companies. I assert that is wholly insufficient to present as an exit strategy. You've got to do the research on each individual target, understand their interests in possibly acquiring you. Why would they do that? How is your product line or services going to complement theirs? What would be the advantage of the two companies merging or them buying you outright and including you in their company somehow? You've got to be able to tell a believable story just by what you learn from the other company's websites and whatever else is written about them. Even better, get to know them, if at all possible. You're probably not going to go call up the CEO of IBM and Intel or the head of GlaxoSmithKline if you don't know them. But there may be some targets and some people in your company or some of the people that are most interested in your company that may. Now, get to know them doesn't mean you go in and say, look, we got you as a candidate for our exit strategy. We'd like to talk to you further. No. You establish a professional working relationship. You do this under the premise that you want them to understand what you're doing. And you're going to share your basic strategy and you want to know more about theirs. It's a meeting, get to know you meeting where, quite frankly, they're starting to get to know you. And it's the start of a relationship. A relationship. Keep that word in mind. This is a business relationship that you start early on that's going to last for years. And you nurture it along the way. You take every opportunity over the course of many months and a few years for them to get to know you better and better and better as time goes on. Till some point in time that they'll realize that, man, you've got a lot going for you, and you could add considerable value to their company. So you continue to show how compatible you are in this relationship. But when you first present to angel investors or private investors, and later on when you talk to venture capital firms, if that becomes necessary, you're going to be able to talk intelligently about the companies you know and you're working with that are possible exits. You're not going to commit an exit. You're not going to commit an amount of money. You're not going to commit a multiple or anything like that. But the investors that are investing in your company early on are going to want to know you are thinking about this subject and that you're serious about it, and you are actively establishing these relationships with companies that may be the ones that you exit with. So it's not just one, it could be several. Who knows how these relationships are going to play out. So after you've thought through your exit strategy and how you're going to present it to investors, then you approach the list of investors that you think are compatible with your business model, compatible with their expectations for exits, and go through your shtick, your investor pitch, and ask them if tell them you're raising money and how much, and have all those conversations. And you'll be able, in the course of the presentation, you'll be able to tell them what your exit strategy is and who you've started relationships with. So from the very initial plan presentation you make to them and all of the updates that you give them over the course of them being an investor, you will continually show the progress you've made in nurturing these relationships, leading someday to an exit. So that's the secret sauce I wanted to share with you tonight. I do have one question here, which is, well, how do you manage the expectations that you're setting? Well, first of all, you don't set expectations, particularly early on. You don't set expectations with your investors. You don't set expectations, God forbid, with the companies that you want to be your exit partner until you get to the point where there's serious conversations and an ensuing negotiation. So up until then, it's we know each other, we find we're compatible. It's a good idea that we're working together. Maybe you've done some projects together, but you're not talking about exits until the point in time where one of you conclude that the world would be better off if we were the same company. And then you start some serious discussions about it. But the expectation setting has got to be done very carefully. And in all these investor pitches, you don't commit a point in time or an amount of money or a multiple. You can, though, talk about possibilities without making a commitment. So be careful on that. Well, the other question is, why do we talk about this so early? I think is what the intent of this question is. Well, because your investors want to know that you're thinking about this, that you got the right kind of head on your shoulders, that you've thought about how you're going to help the investor make money by getting to an exit at some point in time, some reasonable point in time that's compatible with their expectation of an exit. So you're going to have conversations about what they want and what you want. And if you find that you really indeed are compatible, as you did in your initial analysis, the investment discussion can continue. So believe me, the kind of buzz that I'm hearing out there in RTP land and other places I've talked to people about this is that there's going to be more and more conversations like this very early on. And entrepreneurs are going to be expected to talk about What are the exit possibilities here that should interest us? I think that's it for questions. And look, I really enjoyed sharing this with you. I hope it was helpful. I'll replay this a few more times over the next couple of days. But glad you could participate in Monday Night Live with EntreDot. Again, my name is Bill Warner. Thanks for watching. See you soon. Bye-bye.